Imagine waking up on a Tuesday morning. The sun is shining, but your phone lights up with frantic notifications. You try to log into your banking app, but the screen spins. System unavailable. You walk to the ATM, the line wraps around the block. The screen is dark. This isn't dystopian fiction. It is the mathematical inevitability of a leveraged system pushed beyond its breaking point. We view the banking system as an unshakable fortress, but beneath the surface, it is a fragile network of dominoes held together by confidence and complex derivatives like credit default swaps. When confidence evaporates, the fortress doesn't just crack, it liquefies. We are witnessing the precursors right now. The quiet spike in overnight repo rates, the inversion of the yield curve, and widening spreads on corporate bonds. These aren't dry statistics, they are tremors before the earthquake. The global system operates on just-in-time liquidity. When that flow stops, the mechanism seizes up. Most won't realize the severity until their card is declined at the grocery store. But the data is screaming. This is the anatomy of a system failure. The cracks in the foundation are rarely visible to the naked eye until the walls begin to buckle. The primary indicator of this impending failure is the perilous state of commercial real estate. With remote work normalizing, office vacancy rates in cities like San Francisco and New York have surged, leaving landlords unable to service debts. These toxic assets sit heavily on the ledgers of regional banks, creating a precarious exposure reminiscent of 2008. But the catalyst is the interest rate environment. The rapid tightening by the Federal Reserve aimed to curb inflation, but it inadvertently devalued the massive bond portfolios held by these very banks. We call these unrealized losses. As long as the cash stays in the vault, the loss is theoretical. But if a liquidity crunch hits, if rumors spread and withdrawals accelerate, banks must sell these bonds at a deep discount, turning paper losses into fatal realities. Watch the credit default swaps, CDS. When the cost to insure against a bank's default spikes, smart money is betting on a crash. The yield curve remains inverted, screaming a warning that capital is fleeing safety for liquidity. The system is blinking red. To comprehend the mechanism of a total collapse, one must look beyond the teller window to the opaque plumbing of interbank lending. The modern economy runs on credit, not cash. When confidence wavers, the mechanism of contagion activates instantly. It begins with counterparty risk, the fear that the other bank will not repay a short-term loan. When this trust breaks, the interbank lending market freezes. Liquidity, the lifeblood of the economy, evaporates. This is not a slow decline, it is a cardiac arrest. Banks hoard cash to survive, causing a credit crunch that suffocates the real economy. Businesses relying on revolving credit lines for payroll suddenly find them cut. The velocity of money collapses. Worse, automated trading algorithms programmed to limit risk trigger massive sell-offs simultaneously, creating a flash crash scenario in asset prices. This forces margin calls on leveraged institutions, compelling them to sell safe assets like gold or treasuries just to raise cash, dragging the entire market down in a synchronized spiral. The interconnectedness that makes the system efficient is precisely what makes it deadly. History serves as a relentless teacher, offering a grim roadmap of what occurs when banking architectures capitulate. We often dismiss these catastrophes as emerging market anomalies, yet the underlying mechanics are universally applicable. Consider the Asian financial crisis of 1997. In nations like South Korea, currency pegs snapped under pressure, obliterating the purchasing power of the middle class overnight. The IMF intervention that followed imposed austerity that scarred a generation. Shift the lens to Argentina in 2001. To stop a bank run, the government enacted the corralito, freezing private accounts. The image of citizens banging pots against shuttered bank doors defines the helplessness of systemic lockup. In Greece, during the sovereign debt crisis, capital controls limited daily withdrawals to a mere €60. Even now, we watch Turkey and Venezuela, where currency debasement erases lifetime savings in months. These are not isolated incidents. They are recurring patterns of leverage and loss. When debt to GDP ratios become unsustainable, the laws of economics do not grant exemptions based on geography. The warning signs are written in the ruins of foreign banks. When the contagion reaches the core of the U.S. economy, the impact is immediate and visceral. The first casualty is the credit market for small and medium-sized enterprises. These businesses, responsible for nearly half of U.S. employment, depend on regional banks for operating capital. When those banks seize up, credit lines vanish. It creates a domino effect. Payrolls are missed, inventory orders are canceled, and layoffs begin within weeks, not months. The housing market, heavily reliant on the mortgage-backed security machinery, freezes. It isn't just that prices drop, it is that transactions stop entirely because lenders refuse to underwrite new risk. Simultaneously, the destruction of paper wealth in 401ks and pension funds triggers a psychological contraction. Consumers stop spending. Since consumption drives 70% of American GDP, the economy enters a deflationary spiral. While the cost of assets collapses, the cost of living may paradoxically rise due to supply chain disruptions caused by insolvent logistics firms. The separation between Wall Street and Main Street evaporates. The banking crisis becomes a kitchen table crisis. In the face of systemic seizures, the Federal Reserve has only one blunt instrument: the printing press. We saw the playbook in 2008 and 2020. The central bank acts as the lender of last resort, flooding the market with liquidity to unfreeze credit markets. They will likely slash interest rates to zero and restart quantitative easing on an unprecedented scale, buying toxic assets to clean bank balance sheets. But this time, the cost is different. With inflation already a volatile variable, injecting trillions of dollars risks de-anchoring currency stability. The government will simultaneously move to reassure depositors, potentially lifting the FDIC insurance cap beyond $250,000 to prevent a universal bank run. However, these bailouts create a vicious cycle known as moral hazard. If banks know they will be saved, they take greater risks. Furthermore, there is a growing speculation that the ultimate solution to a banking collapse will be the introduction of a central bank digital currency, a CBDC. This would allow the Fed to bypass commercial banks entirely, depositing stimulus directly into digital wallets, effectively ending the banking system as we know it and ushering in an era of total financial surveillance. In a landscape where the institution itself becomes the risk, survival demands a strategy of decentralization. The first line of defense is physical liquidity. Holding 1 to 3 months of expenses in cash is not hoarding, it is a hedge against the bank holiday, the period when digital access is suspended to stop a run. Yet holding fiat currency is a melting ice cube during inflation. Thus, allocation to bearer assets is critical. Physical gold and silver have historically served as the lifeboat when the ship of state currency lists. They carry no counterparty risk. Simultaneously, Bitcoin, when held in self-custody, offers a digital exit ramp, a parallel system immune to freezing, provided you control the keys. Beyond assets, look at liabilities. Eliminate variable rate debt immediately. In a liquidity crisis, rates can spike to punitive levels, turning manageable payments into instruments of foreclosure. Finally, invest in the tangible: skills, localized food security, and community networks. When the electronic ledger goes dark, the real economy is all that remains. We conclude with a fundamental truth. The banking system is not a vault, it is a ledger of trust. When that trust evaporates, the mathematics of leverage ensure a swift and brutal correction. We have examined the warning signs, the inverted yield curves, the toxic commercial real estate, and the fragility of interbank liquidity. These are not anomalies. They are the structural faults of an era addicted to cheap debt. The collapse, when it arrives, will not announce itself with a press release. It will arrive in the silence of frozen accounts and the chaos of repriced reality. But within this volatility lies opportunity. The transfer of wealth during a crisis is the greatest in history, moving from those who trust blind institutions to those who hold tangible value. This is your wake-up call. The era of passive reliance on the system is over. Financial sovereignty is no longer a luxury, it is a necessity. Do not wait for the bailouts to save you. Build your resilience now. The system may be destined to reset, but your future is still yours to write. The devastation of a U.S. banking collapse does not stop at the Atlantic or Pacific. It triggers a geopolitical earthquake that redraws the map of global power. For 80 years, the United States has enjoyed the exorbitant privilege of printing the world's reserve currency, effectively exporting inflation to the rest of the globe. But a systemic failure in New York sends an undeniable signal to Beijing, Moscow, and Riyadh. The custodian is insolvent. We are already witnessing the precursors with the BRICS alliance stockpiling record amounts of gold and settling trade in local currencies to bypass the SWIFT system. In a collapse scenario, this trend becomes an avalanche. Foreign central banks, desperate to protect their own ledgers, would likely dump U.S. treasuries, causing yields to spike uncontrollably. For the average American, this means the end of cheap consumption. Electronics, clothing, and energy, historically subsidized by the dollar's strength, would skyrocket in price. The collapse of the banks marks the definitive end of American economic hegemony in the violent birth of a multipolar monetary order where the dollar is no longer king, but just another currency fighting for survival. The future is not a destination. It is a consequence of the choices we make today. We're standing at the precipice of a great resetting, a transition from an era of illusory wealth to an era of tangible reality. The banking collapse scenario is not merely a financial correction, it is a restoration of natural law in economics. Those who ignore the tremors will be buried by the earthquake. Those who prepare, who diversify out of the dollar, who eliminate counterparty risk, and who build resilience will not just survive, they will become the architects of what follows. The system is designed to protect itself, not you. Do not fear the collapse, fear the inaction that leaves you vulnerable to it. As the screens go dark and the ATMs run dry, remember that true wealth has never been a number on a server. It is resourcefulness, it is gold in your hand, it is the land beneath your feet and the community at your back. The storm is coming. The umbrella of the state is full of holes. It is time to build your own shelter. System failure is inevitable. Your failure is not. This documentary was not designed merely to entertain. It was constructed to prepare you for a shift that most will not see until it is too late. The information shared here challenges the comfortable narrative of the mainstream financial media. If you believe this warning is vital, you have a responsibility to act. Hit the like button, not for our vanity, but to force the algorithm to show this reality to others who are still asleep at the wheel. Share this video with your inner circle. It might be the single conversation that safeguards their financial future. But listen closely. The banking collapse is only the first domino. The solution the system will propose is far more dangerous than the crisis itself. We are currently investigating the CBDC trap, the government's plan for programmable money that could end financial privacy forever. You absolutely cannot afford to miss that report. Subscribe and turn on notifications right now so you are alerted the moment it drops. Finally, I want to know your stance. In a world of failing banks, what is your primary lifeboat? Gold, Bitcoin, or land? Leave your strategy in the comments below. Let's build a community that survives the crash.